Hello, my name is Justin Turner, and this is my financial analysis project for Finance 381 with Dr. Cresson. Today in this presentation, I'm going to present to you three companies. The companies that I have chosen are ExxonMobil, of the oil and gas industry, Humana, of the healthcare industry, and lastly, Lamar, of the advertising industry. If you're not really familiar with Lamar in Louisiana, just look at the billboards as you're driving on the interstate, and you'll more than likely see the Lamar logo below it. I want to ask three questions about these companies. These companies want a loan from me as an investor. I want to determine which of these companies that I would want to give a loan to for 6 months in the short term, 5 years in the long term, and lastly, which company would I like to invest in as a shareholder. To determine who I would want to give a short-term loan to, we're going to look at three different ratios. Now, these three ratios are liquidity ratios. How liquid are these companies? As we know, liquidity is cash or anything that can be converted to cash. When we look at these ratios, we're talking about the current ratio, the quick ratio, and lastly, the cash ratio. Taking a look at the current ratio, it is current assets over current liabilities. Now, we want this ratio to be high, but not too high. It'll show inefficiencies with cash or other short-term assets. Normally around a 2 is fairly acceptable, but anything below a 1 shows us negative net working capital. And we have great examples of both. As you can see, Humana surpasses Lamar and ExxonMobil as recent as 2014. Lamar started out fairly high, but started a downward trend over the course of the next 3 years, trending upward in 2014. ExxonMobil was the perfect example of the negative net working capital, as you see that their current ratio was below a 1. So it's not something I really want to trust as I want to give my short-term loan to. So I'm still looking at Humana and potentially Lamar. Let's take a look at the quick ratio. Now the quick ratio tells us current assets minus inventory over current liabilities. This will tell us how much inventory these companies truly have. And as you can see, the highest any of the companies got wasn't even to a 1.7. So it tells us there's not a whole lot of inventory. But once again, Humana surpasses Lamar and ExxonMobil. ExxonMobil not even getting above a 0.6 ratio. Still not good. Humana is looking very good here. Lamar, once again, you see a downward trend after starting out fairly high in 2010, trending downward and then having a slight increase in 2014. The next ratio we want to look at, and that I feel will be most important in giving this short-term loan to, will be the cash ratio. Now, the cash ratio is cash over current liabilities. How much cash do they have? How liquid are these companies really? And once again, Humana surpasses Lamar and ExxonMobil by a good amount. And you see Lamar once again trending downward, which still is not good. And then ExxonMobil not even getting above a 0.2 ratio. So I immediately can eliminate ExxonMobil. So after looking at all three ratios and determining which companies would be the most liquid, I would rather give my 6-month loan to and have full trust that they would pay me back in the short term to Humana. The next question I'm asking is, a company wants a loan for 5 years, long term, and I have a choice to make. Which of these three companies would I give that 5-year loan to? Well, we're going to take a look at two ratios here. I want to find out how much risk these companies are taking and how much these companies are willing to honor their debt. Now, these ratios are the times interest earned ratio and the equity multiplier ratio. When we look at the times interest earned ratio, we see ExxonMobil make a huge comeback from the short-term loan, and you see they're up near 100. So I have great confidence that ExxonMobil actually honors its debt very well. Humana, around the 20, also honors its debt fairly well, and Lamar, not so much. I don't have full trust in Lamar to honor its long-term debt. So it's not giving me great confidence in Lamar. But I am looking at Humana and I am looking at ExxonMobil as potential candidates. When we look at the equity multiplier, we're trying to figure out how much risk they're taking. This is more of a leverage ratio. And Lamar, for not honoring its debt very well, they're taking a lot of risk. It's not necessarily good, even though this time the downward trend is a good thing. They're not taking as much risk as they were in 2010 when it was above 4.5 ratio. But once again, you can see Humana and ExxonMobil both staying within 2 to 2.5. So when I look at when I look at these three companies, I notice that Lamar takes way too much risk and doesn't really honor its debt that much. ExxonMobil takes the least amount of risk, which plays huge. Even though Humana does honor its debt very well and not taking that much risk, the company that I wound up choosing to give a long-term loan to is ExxonMobil. The last question I would like to ask myself is, which company would I like to invest in as a shareholder? Well, to answer that question, I want to ask, how much from sales, assets, and equity are they putting back into the company? How much are they putting back into their net income? Well, the first ratio we're going to look at is what I consider the most important ratio, and that, of course, is the return on equity. Now, you can see Lamar started out in 2010 in the negative, which is a big, big, big error on their part, wondering what happened in 2010. We'll see what happened. We'll see what drove that number in 2010. But as you can see, over the course of the next 3 years, they started trending upward, and they had a huge spike in 2014, actually surpassing ExxonMobil and Humana, which to me I found that very shocking. If it started in the negative in 2010, or it was in the negative in 2010, they've shown great improvement, which gives me a little bit of confidence that, hey, possibly I can invest in this company. Now, Humana and ExxonMobil, they both have a similar trend here, as they're both going down over the course of the 5 years, but ExxonMobil still maintaining a high return on equity. So let's see what really drives these numbers. We're going to take a look at the profit margin. We're going to take a look again at the equity multiplier, because we're trying to figure out how much risk they're taking when they earn this profit. And then lastly, we're going to take a look at the total asset turnover. When we look at the profit margin, we see actually Lamar has a higher profit than ExxonMobil and Humana, which is, to me, it's quite shocking, given that they started out so negative with a return on equity. So how do we know that Lamar made this high profit? Very simple. They took the most risk. High risk, high reward. But it's still not something I fully want to trust in, because what would happen if they took an even higher risk? If you see in 2010, they took high risk, but their return on equity was in the negative. Didn't show very much confidence there. And once again, Humana and ExxonMobil stayed in the 2 to 2.5 region, so I know that they are not taking much risk, but they are making a little bit of profit. Now, when we look at the total asset turnover, we look at Humana above ExxonMobil and Lamar, again, because Humana, shown as they showed in the current ratio, they actually have more assets. Even though that this is going to be in the long term, they still have more assets than ExxonMobil and Lamar. Lamar, once again, trending downward, not even getting above a 0.5 ratio. Not good. The next ratios we want to look at the return on assets, how much these companies are getting back from their assets, and also the price to earnings ratio. Now, the price to earnings is going to be key in how confident I am in this company. This is going to that ratio will show significant growth opportunities. So when we look at the return on assets, we see once again ExxonMobil leading the way. And once again, we see in 2010 Lamar in the negative, which is not good. Now, once again, a lot has changed in the past 5 years, and they trended upward very nicely. But the inconsistency is still something that I'm not fully wanting to invest in. So I still look at ExxonMobil and I still look at Humana as the same. As you notice, they have the same trends, even though ExxonMobil had a higher return on asset than Humana. Now, once again, we're going to look at the price to earnings ratio, and whoo, man, to see what happened in 2011 with Lamar having a really giant spike in 2011 up to near 1,000. But here's where I lose confidence. Yes, they got to 1,000, but they started out in 2010 at 0. They didn't have a ratio. Did not have one. And then the next year, they went from 1,000 almost all the way back down to 100, to near 100. And then they started trending downward. That's not giving me a lot of confidence. ExxonMobil and Humana stayed fairly low. So really, I didn't have a whole lot of confidence in any of the three companies. But when I really look at all of these ratios, when I look at the return on equity, the return on assets, when I look at how much risk they're taking with how much profit they're taking, I'm a little indifferent. So the companies that I would want to invest in would either be ExxonMobil or Humana. And this concludes my presentation. Thank you very much, Dr. Cresson. I look forward to hearing your response.